Today, start chapter 3. And chapter 3 is a little bit more difficult than the handouts. It's or chapters, I should say, and it is it's difficult because you have to go through this journal entry system, the wacky journal entry system, but it's also you have to do a lot of calculations in it. So this is kind of the chapter that people tend to have difficulty with. So anyway, we'll go ahead and get started on it. And we're back to the journal entries here, just so you know. Okay. And this kind of goes into a little bit of it here. Financial statements are made for a specific period of time. For instance, the net income for the year 2021. The problem you have is that a lot of transactions will go for more than 1 year. For instance, the second one here we talk about the truck. You know, you're bringing in the journal entries for this year, 2021. You have this truck that's going to last for many years. So you have to get that transaction somehow into this year, you know, and not just purchasing the truck, but as you use the truck. And there's also things that span more than one period. They can go from, you know, for instance, if you make a sale in December and they don't pay you until January, you know, that transaction's been spread from one period to the next period. And so that's kind of the problem that we're having with when we're talking about these adjusting entries, is that these are things that don't fit comfortably into the period we made. Sometimes you hear it called an artificial period. We have an artificial period of 1 year. Even though these transactions have been going for many years, we have this artificial period we have to fit everything into. Okay, and they're going to adjust the accounts. Okay, so we basically have two different types of accounts that we talk about. And the first one is accruals, and this is the one that is probably the most difficult. Oops, hey, I can't. Is that weird? Oh, okay. So accruals are the money hasn't changed hands. The transaction has occurred, but the money has not changed hands. And that's the most difficult one, because normally in our normal life, we think about when money changes hands, that's when the transaction happens. But in business, a lot of times that isn't the way it happens. So accounts payable, accounts receivable, those are things that the transactions happened. You made a sale or you purchased something, but the cash hasn't changed hands yet. Deferrals are just the opposite. It's when something happens, but you defer it. You know, when you buy supplies, I think we talked about this. You buy supplies, so the supplies are an asset. You know, we paid for them, but until we use them, we don't really expense them. So the money's changed hands, but you know, the item themselves have not been used. The same thing with prepaid and unearned revenue. The money's been paid up front, but we're not going to recognize it till later. And so this is kind of, I don't know, this may be a little more confusing, but kind of an idea of if you have, you know, these transactions, A, B, C, D, E, you know, that they might span more than one period. They might go for 2 periods or 3 periods or whatever, but they might go from one period to the next period. They might be, so we have to figure out, you know, how much of this is going to go in 2021, how much of it is going to go into 2022 and 2023 and so on. So that's the problem that we're running into, that these transactions do not fit comfortably into one period. Okay, and we're going to find some, this is one of the kind of wacky things about it, adjusting entries. All adjusting entries have either a revenue or an expense, not both. They have one or the other. And another little oddity of it is they never have cash involved. So they either have to have a revenue or expense, and they never have cash involved. The actual journal entries themselves are usually not as difficult because we know the revenue. Yeah, I got it on here. Do I have it on here? Revenues are always, oh, I don't have my, this is not an updated one. All right, well, you know, revenues are always, excuse me, revenues are always credits, and expenses are always debits. So as far as the journal entries are concerned, it's usually not as difficult because there is going to be a revenue and an expense. The calculations are really the difficult part. Okay, let's go ahead and start doing these. It'll hopefully make more sense. All right. We have a 1-year insurance policy. It was purchased for $1,200. The cost of the insurance policy was $100 per month. At the time this journal entry was made, okay. So first of all, how did this amount come about? The $100 per month. How was that?
The 12 months.
Yeah, exactly. So that $100 a month, that actually came from, the cost was $1,200, I think. And divided by 12 months. So this is how that came about. That okay, so we bought it on April 1st. So down here, we're going to have the month. So April, so we're going to count all of April. The question is, how many months do we have it for? How many months have we used up yet? So we had it for April, May, June, July, blah, blah, blah. We've had it for a total of 9 months. So how much was used?
900.
Yep. So we have used I did something bad there. Oops, I made it worse. Oh, weird. All right, well, anyway. All right, so yeah, so 900, we had it for 9 months. and $100 per month. Okay. Okay, so we are going to make the journal entry. Now, so we have an asset of $1,200 at prepaid insurance. Now we've used 9 months of it. So is that going to reduce the asset or increase it?
Reduce.
Reduce, good. Now, if this is a debit, what are we going to use to reduce it?
Insurance expense.
Yes, we are going to use insurance expense. For 900. And what's going to be the credit? I'll give you a hint. It's not going to be cash because we already paid the cash in April.
Prepaid insurance.
Good. This prepaid insurance account is, we no longer have $1,200. Let me see if I get these closer together. Okay, so this prepaid insurance, we have to reduce it by 900. So we're taking 900 out of that prepaid insurance account. We no longer have 900 of it. So here's a question for you. How much do we have left in the prepaid insurance?
$300.
Yep. If you come down here, we'll say so our prepaid insurance, we started out with 1,200 in there. Those are T accounts that we had in the last chapter. And if we were to see what's left over, it's 300. And here we'll have insurance expense. And that will be for 900. Oops. And again, coming down all the way down here. Expenses are always debits. Okay. Oops. So this is our first adjusting entry. And again, you'll notice that there's either an expense or revenue, in this case, an expense, and no cash. So no cash, expense or revenue. And these would be the ending balances in those accounts. It makes it more confusing, I don't know. But so we're taking it out of prepaid insurance. We've used it up. Again, you kind of see that this journal, that this transaction doesn't fit into 2021, right? It goes into 2022. Well, we have to make financial statements in 2021, right? So that is why we're having this to do these adjustments. Okay. Number 3. The one-year insurance policy was purchased for $3,000 cash. Insurance cost was $250 a month, kind of like we did before. So 3,000 divided by 12 months equals $250 a month, right? Check just to make sure, Mr. Calculator. Yep. Okay, so we made a journal entry here. And again, the cash is already paid, so we're not going to worry about paying cash in the future. Now, it was purchased on October 1st. So here is the question. How many months did we use it for? How many months were used up, I should say, in 2021?
3 months.
Yep. So we used all of October, November, and December. So we used 3 months of it. Okay, so oops. What is that, 750? You know what? Let me get these a little closer. So we use it for 3 months, and we use 750 out of it. So we had to take 750 out of that prepaid account, and you'll notice that it is, so it's a debit. So if we reduce it, we're gonna have the insurance, it's an asset going down by 750. Ooh, not bad. Sorry. And then the expense, same as last time, insurance expense. So that's it. And again, this one goes into more than 1 year. We had it for 3 months in 2021, and it's going to go for another 9 months in 2022. And again, that's why we're doing these adjusting entries, to adjust it for. These transactions that span more than one period, we're trying to get how much of it belongs in this period, how much of it belongs in the other period. The boring accounting definition, definition term for doing that is that you try to match the matching rule. You try to match your expenses. You try to match your expenses with the revenues for the same period, basically. They use a little different terminology. They say match the revenues with the expenses incurred to generate those revenues, but basically it's matching revenues and expenses in the right period. And it's one of those things that's kind of intuitive. If you're making your income statement for 2021, well, you want your revenues expenses for 2021. But anyway, okay, so prepaid insurance. Start out with 3,000 in there. Took out 750. Okay, so we still have what is that? 2,000, 2,250, I think. I better use Mr. Calculator just to make sure. Yep. So this will be the ending balance in the prepaid insurance. Insurance expense, we debited that for 750. You know what, in hindsight, I just realized what I should have done. I should put the expense over here. I'm not going to change it now because I already started out on the wrong foot. And if I change it now, it might throw people off. But in the future classes, not this class, future classes will benefit from this. None of these crossed lines here. So anyway, so the prepaid insurance, we really don't have 3,000 in prepaid insurance anymore. It's down to 2,250. And we've used up 750 of it. Okay, number 4. Number 4, you get no help. You have to figure out how much it is per month, and then figure out how many months it's for, and make the adjustment. So I'm going to be quiet for a little bit and see if you can figure out number 4 on your own. I'll put the answer up here in a little bit, but give it a shot. Okay, I think this is what you should have got. You got $50 per month as the amount. So we had $600 we paid for it for 1 year. So it's $50 per month. And here's what, and the one that trips up people the most is counting the months. Now, you'll notice that this was purchased on the 1st of August. So we're going to use all of August. Now, if this had been purchased on the 31st of August, if this had been purchased at the end of the month, you wouldn't have used August, you just start with September. But yeah, I mostly put it at the first of the month just because it's, you know, we're looking for the idea, not necessarily a complete look at all the scenarios that could happen. All right, so 5 months worth is $250. And the journal entry is insurance expense. Insurance has an R on it and expense has an E at the end, just in case you guys are wondering. And then this will be and this is an asset going down. Right, oops. 50. So we're reducing this account by 250. So if it has a debit balance here, oops. You know, then we come down here to reduce it, we're going to credit it. And again, there's no cash in here. There's no cash in these adjusting entries. We already paid the cash in October. So we're not gonna, no, we didn't. We paid it in August. I'm sorry. I was lying there. Bad habit. So we paid it in August and so we're not gonna pay it again. So it's already been paid. But we're just adjusting these accounts. Okay, and I'm gonna keep with my prepaid insurance on the left. So this was 600. So it's 250. So we still have 350 prepaid, and the insurance expense. Expenses are always, oops. Expenses also have an X in it, but they're also always debits. So those are prepaid. Prepaid adjusting entries. Okay. And by the way, just so you know, the adjusting entries are hard. I think I told you guys this boring story again. Doing auditing one time, and they were putting one of these adjusting entries through, and they put it in, thought it was wrong, reversed it back out. Said, okay, no, wait, that's right, put it back in, thought it was wrong, reversed it back out. They did it 6 times. And I've had, you know, in going through, this is an auditor, when I go through adjusting entries, I've seen, you know, if there's a problem, a lot of times, if there's mistakes made, a lot of times it's with the adjusting entries. Just because you get to these calculations and sometimes it's not, you know, as obvious as you might think. So, if these look wacky, they should, because even to people who have been doing audit or accounting for years, you'll still find, mistakes are made sometimes. Okay. Unearned revenue. So now remember, unearned revenue is when someone has paid us ahead of time. It's sort of like the opposite of the accounts receivable. Accounts receivable, they haven't paid us. We did the work, they haven't paid us. This is just the opposite. They've paid us, but we haven't done any work. And it could come out from any, whatever. Someone wants you to do a job, you don't know who they are. You say, okay, I'll do it, but you got to pay me ahead of time because I don't know who you are. So, the cash has changed hands. So you have the cash, but you have to do the work, or you have to give the cash back. So I think what we're looking at here. So these are, this is the journal entry that you'd have made. Unearned revenue is a liability. Someone paid us money. We haven't done anything. We'll pick up the cash. We do have the cash. They gave it to us. So we have the cash, but we haven't done any of the work yet. Okay, at year end, 1,800 of the revenue had been earned. Okay, so we did $1,800 worth of work. All right, so let's think about this for just a minute. We gotta make an adjusting entry. There's no cash. The cash is, we already got the cash on November. So the question is, what kind of accounts are we gonna use? Now, are we gonna have a revenue or expense? What do you think?
Revenue.
Yep. So we are going to have a revenue in this case. Okay. Well, there's something very good about having a revenue in your journal entry. Revenues are always
Credits?
Yep. So revenues are always credit. So we know what the credit is. Now notice, if you know what the credit is, you know what the debit is too. Okay, so we're gonna have a revenue. And if you want, you can put that that's earned. They usually don't put that in there because revenue by definition is earned, but you can put it in. There's nothing wrong with putting earned revenue in there, or revenue earned, or however you want to put it. Okay, so we've earned 1,800 of it, right? Okay, so what goes on the other side? Now remember, there's no cash here.
Unearned revenue.
Yep. Yeah, the cash has already changed hands. So this will be our unearned revenue. We owe them $1,800 less, right? So the liability going down. Again, the nice thing about having a revenue and expense on these is that you know what the other side what it has to be. Even if you don't know whether this is a liability or what it is, you can still do the journal entry correctly as long as you know that revenues are always credits.
Is the unearned revenue 1,800 or 1,600?
Good question. It's going to be, well, we will have 1,600 left in it. So we do the T accounts, you'll see, but we have actually earned the 1,800, so pick that up as earned revenue. we come down here, so here's the unearned revenue. Lost my cursor or something. Okay, unearned revenue, we had 30, credit 3,400. We just took out 1,800 out of it. And so you're absolutely right. What is left over, now you don't make the journal entry for this. You make the journal entry for what is earned. But there is 1,600 left over in that account. I'm going to put something, I'm going to put a note on here just to kind of round this out a little bit. Adjusting entry amounts. I should put this somewhere up. If there are revenues, it's how much was earned. If there are expenses, so adjusting entry amounts, and again, this, somebody probably, I should put it earlier. So if they are revenues, I don't think, let's make revenues green. Okay, so how much was earned? If they're expenses, how much was used? And what, whatever the ending balance is, will come out to be whatever the ending balance is for the asset or liability account. By the way, so just also maybe make one more note about it. One of the things about these journal entries, there's always a revenue or an expense. It's one or the other, not both, one or the other. And there's always a balance sheet account. So there's always going to be a balance sheet account and a revenue or an expense. So for revenues, how much did we earn? Will be the amount. And for expenses, how much did we use? So coming up here for these prepaid, how much of the insurance did we use? Now there is going to be an ending balance of what we didn't use. Sorry. All right. So there's going to be some amount in there in the balance sheet account of what is left, but we're only looking for what is earned if it's a revenue or what is used if it's an expense. Okay. Oh, here's a mathy thing for us. Yeah, I think this came out. I think there's a problem in the book that's similar to this. And that is, okay, we got the 5,000 of unearned revenue. We got customer deposit, or whatever we want to call it, of $5,000. At year end, 70% of the unearned revenue had been earned, so we have to take 70% of this, so it's a little bit more mathy. By the way, a lot of times, construction jobs and things like that, they will do it by percentages. And they could do it by percentages of all different things. They'll do it by percentages of materials, percentages of labor, and all that kind of stuff. Just as an example. So anyway, so seeing it in a percentage is not as unusual as you might think. All right, so we just take the percentages of it. So we have 5,000 times 70%. If you have a good calculator, you can probably put the percentages in. If you have a, probably just put the 0.7 in. All right, so what is that? 3,500? Better check. Yep. Okay, so 3,500 of it had been earned. And so that's going to be in our journal entry. Now there is going to be still some that is still unearned, but we're going to go with 3,500. Okay, so let's see here. We have to, well, there's going to be a revenue. Revenues are always debits.
Credits.
Credits, thank you. And again, if you don't think of this as earned revenue, that's fine. By definition, all revenue is earned, so this is not a wrong entry at all. 3,500. And our unearned revenue, which is really not a revenue at all, it's a liability. Going down by 3,500, we earned 3,500 of it. We no longer owe them for 3,500 of this thing. You know, I'm when I think about this, I should put this in a all of them. Yeah, I have to figure out somehow how to put that in all these. Okay. So down here, revenue, we had 5,000. We took out 3,500. So we have left, we still have to earn 1,500. And we will still pick up 3,500 of that. So we earned 3,500 of it. We no longer owe them for 3,500, and this is our ending balance in that. So on the balance sheet, this unearned revenue shows a liability of 1,500. This revenue will show up on the income statement for 3,500. Yeah, so the problem with these is that there's a lot more calculations involved. And then also we have to go back into this wacky 400-year-old shorthand for journal entries. By the way, adjusting entries are just journal entries. They're just used to adjust the accounts in the year, but they are journal entries. There's nothing, if you're doing an accounting system, using accounting system, well, adjusting entries will go in just the same as a regular journal entry. There's nothing magical about them. Okay, we have next. Depreciation. We'll do this one, we'll call it a day. Okay. Depreciation, and this one is a little bit wacky, wackier than most. This has to do with, you have something that's very long-term, like a truck, a building, some equipment. Those things last for a really long time. And while they're usually, oftentimes they're very expensive, but if the year that you buy them, though, it's not just going to benefit that year. It's going to benefit the company for the next however many years. So, for instance, this truck will benefit the company. To say the business probably. Oops. So, the life of 10 years. So notice that means is that this will benefit the company having this truck for the next 10 years. And so the question is, well, how much of this truck are we going to use up each year? How much of it is going to be used up? Okay, so the truck is estimated to last for 10 years and then be worthless. So it costs $20,000. So how much are we going to use of this truck basically every year? How much do you think we're going to?
2,000.
Yep. So, oops. Truck for 20,000 divided by the 10-year life, and again, it's going to benefit the company. Oops, that's not high school 10. It's going to benefit the company for the next 10 years. So as it benefits the company, we expense it. So we have $2,000 a year. And we're going to call this depreciation expense. Okay, this is where it gets wacky. And we actually had this a little bit in chapter 4. We're going to have a depreciation expense. Now, we're using up $2,000 worth of this truck. It was purchased on the first of the year. So we use it for the entire year, 2021. Expenses are always debits.
Debits.
Yep. Okay, so we're gonna have probably equipment. You could also put it in this truck. That's fine too. What are you doing? Depreciation expense. Now, it would make, you're probably thinking, well, okay, we have this equipment account. We should take some out of it, right? You should take, this equipment account is 20,000, but we're saying it's worth $2,000 less. So we've used 2,000, we write this account down. Actually, you don't. This is where that wacky accumulated depreciation account comes in. And the very morbid way of remembering the journal entry for depreciation expense is at the end of its life, it is dead. This is the same journal entry you always use for depreciation. DEAD. End of its life, it's dead. Okay, so you'll notice something kind of wacky here too, is that, okay, you get this equipment account on the books for 20,000. Say, wait a minute, that equipment is going to be on the books for 20,000 still, right? Because the equipment is not in this journal entry. There's no equipment in here. These two accounts let's do it differently. These two accounts will go together for the next 10 years. And I know it's strange, this is a contra account to this, but that's just the way we do it. And I'll show you why we do it maybe in a minute here. So on the balance sheet, you're going to have your liabilities and shareholders' equity and all this kind of stuff. But somewhere in here, you're going to have this equipment. For 20,000. And then you're going to have accumulated depreciation. Is going to subtract out 2,000 of it. And so you're going to have the what they call the net equipment. Will be 18,000. So this is going to be on the books for and this amount down here is what you're going to add into on the balance sheet. So it's wacky, but there's a reason why we do it. I'll just show you in a minute. But this accumulated depreciation is going to reduce that asset account. That's what we call a contra account. So it's a contra account to the equipment. So each year, this depreciation is going to keep going up and up and up. At the end of 10 years, it'll look like this. So this is what it'll look like at the end of 10 years. you know, it'll just keep going up and up and up until it's at the end of 10 years, it'll be worthless. Was that thing? Let's go ahead and let's save this one. I'm gonna save this. I'm gonna talk about the accumulated depreciation account as why we use it. We'll do the other one next class. So this is just kind of a informational thing. Let's say that we have two different equipment. So let's say, let's see. Sometimes it'd be called the book value or the carry value. So this would be what they call the book value. Messed up something here. Okay, so let's say we have two pieces of equipment. Equipment A costs $125,000. Equipment B costs $6,000. Accumulated depreciation. Oops, change that. Okay, so we have two pieces of equipment. Why not? The book value of each of these is 5,000. Okay. Which of the equipment items is older? A or B? They both have the same book value, the same carry value, the same value that we show on the balance sheet. Which one is probably older? Which one's been depreciated more?
A?
Equipment A.
Yeah, A is older, right? you know, 125,000, but we've depreciated almost all of it, right? There's quite a bit depreciated there. This equipment B costs much less and it's only depreciated so a little bit. So equipment A is much older. And now let's take a look at this from a management point of view. If you're a manager looking at this one worries you. This worries you that I don't know how to use a computer, but this is the one that's going to worry you because it's much older and it probably needs to be replaced soon, right? If it's almost all completely depreciated, it probably needs to be replaced soon, and it's a very expensive piece of equipment. You know, equipment B, relatively anyways, is you know, a cheaper piece of equipment. It's only $6,000 as compared to $125,000. So if you're a manager looking at this, even though the book values are exactly the same, you know, these two are exactly the same amounts, they have a very different aspect as far as management's concerned. Management will say, look at this, go, wow, we need to replace this, and this is a very expensive piece. Whereas if this one, you would say, okay, it's not as relatively not as expensive, and it looks like it's fairly new. I mean, we've appreciated 1,000 of it, but there's probably many more years left in this thing, whatever it is. So that's why we keep this accumulated depreciation. That if you just kept writing it off from the same account and you looked at this, you know, you would say, okay, these two are identical almost, right? Their value would be identical, whereas reality, one is probably much more sophisticated and expensive. The other one is probably not as much so, but is also much newer. So you actually get a lot of information. And by the way, accounting is all about getting as much information to managers, so people that make decisions, as you can. So if someone's making a decision, you want to give them as much information as you can. And that's why we keep this wacky accumulated depreciation account. You know, if you're looking at this and you're saying, why don't we just write off the equipment? It could have been done that way. I mean, this is kind of just the way it's been come about. There's a reason for it, which is this. But yeah, it really is just writing down that piece of equipment, but keeping the original value of it, original cost of it, just because it'll help managers make decisions. Okay, let's stop here. And oops. And we will continue with this next class. Okay, and nothing to turn in for today anyways. And so we will, and I'll get the grading in today. The grading will be done today for everyone. So anyway, I'll stop here and we will pick it up next class. Any questions? Okay. Well, I will see you guys next class. And look at that, 3 minutes to spare. Okay. Have a good day, and I'll talk to you on Tuesday.
Thank you. Take care.
Have a good one.
Thank you.
Okay.
Thank you.
Hey.